Goldman Sachs drops a bombshell. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Goldman Sachs says this major economy is about to come crashing down, and we're going to make the case of why other major economies are going to soon follow. Now let's head over to Bloomberg, where we picked today's story up with the headline, Chinese copper smelters accept lower fees as supply fears rise. And so as we look around the world, we see a broad slowdown in demand. And this is one of the challenges major economies all over the world are going to face. And this is just one indicator out of many that problems for global demand is tumbling. Several major Chinese copper smelters have agreed to a 9% drop in processing fees, falling in line with an initial deal signed 2 weeks ago as a shutdown of a major mine in Panama spurs fears of an oversupply that is of smelters. So what you're seeing here is as they drop their price, we keep in mind that China exports deflation. So when prices fall there, it gets into consumer products, it gets shipped all over the world, and this means the central bankers that are key on perhaps driving interest rates even higher because they're afraid that inflation is going to continue to be a problem. Well, at least in the copper space, it doesn't appear that that's going to be an issue at all. The tighter copper concentrate market doesn't automatically imply a tighter market for the refined metal, since it is partly driven by an expansion in copper smelter capacity. But that's one of the issues here, is if you have a reduction in supply due to a major mine closure, well, that should naturally cause prices to rise. We look at the same thing in the oil market as OPEC Plus looks to tighten supply. But yet there's one problem that we see across the board, is that just because supply is tightening doesn't mean prices are rising. We'll show you why. And this could lead to higher production of metal and so lower prices due to too many smelters. But over time, the lower processing fee could force some of those smelters out of business, ultimately reducing the supply of refined metal, just as many observers anticipate a rapid increase in demand due to the energy transition. Of course, that would lead to even higher copper prices than we have now, and that would eventually backfeed into inflation. But here's what I'm about to show you. When we look at this next chart, even though we're seeing less ore being mined here in the copper space, it doesn't necessarily imply that prices are going to rise anytime soon. In fact, the data suggests they're going to come crashing down, again, bring inflation with it. And here we can see the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. This against global copper prices, that's shown in red. And what I want you to know is that anytime banks are on net tightening lending standards, you see that when the blue line is rising above that horizontal black line. And what that means is simply the banks are making it more difficult to get loans. And when people have trouble getting loans, well, some people don't get them. And since commercial banks are key, they are the only institution that can create new money in our economy, in our debt-based economy. What this means is less new money you have to support the growth and the existing debt. And this becomes a challenge because when you constrain that credit growth, well, suddenly demand comes plummeting down. And here we can see that effect with copper prices. You'll note that between the late 90s and early 2000s, that demand for copper remained kind of muted as prices were flat. But how about during the global financial crisis? We see banks tighten lending standards and copper prices were rising. Then they came crashing down. And do keep in mind, this is not shown on a year-over-year rate of change. Now, of course, everyone's worried about demand. And even though there's going to be too many smelters, at least in China, it suggests that prices are coming down because there isn't going to be enough money to support prices at their current level. As we turn over to Asian factories, they're still under pressure on mixed demand rebound. So as we look at the copper market, we look at that perhaps as a proxy of the global economy. We have to look at demand coming out of the manufacturing sector, because the belief was we were going to achieve this soft landing where we saw this slowdown in the global economy and due to tighter interest rates, but because of the robustness of the labor market, that we're going to see kind of a rebound. And we made the case that says, look, if this thing rolls back over, and we're seeing some early signs that the global manufacturing sector is indeed running out of momentum, well, watch out below, and that does not bode well for copper prices or inflation. While manufacturing purchasing managers' indices for South Korea and Taiwan showed signs of stabilization and activity, the mood in Japan was downbeat, according to surveys published Friday by S&P Global. A private gauge of factory activity in China unexpectedly returned to expansion. Now keep in mind, we're talking very minor moves in the expansion territory. It's not like it's things shot up, as you'll see. It just kind of turned a little bit the other direction. And we can note that these factory surveys are often a bit noisy. They're not very smoothed out like we traditionally see with the government data. So let's take a further look here, because the reading for Vietnam deteriorated as factories were squeezed by higher input costs. But this is a bigger issue: consumers unwilling to pay higher prices. So when we talk about a constriction in credit creation, this is exactly what you want to see, is that consumers either don't have the money to spend or they don't have access to the credit to spend, and in turn they end up rejecting higher prices. Exactly what's happening in Vietnam. The score for Malaysia and Thailand improved, although still remained below 50, the dividing line between contraction and expansion. And if customer demand continues to wane, and well, we're making the case of why it will be detrimental to the Asian manufacturing sector performance in the month ahead. Furthermore, business confidence regarding the year ahead remains historically muted across the region. This, of course, is a dangerous sign, because we know that when demand slows down, that the factories have no other choice, particularly after a period of high inflation where their costs to do business went up. They eventually start to cut labor expenses. That puts more people out of work and on unemployment lines, and that leads to less demand, and in turn, it causes the factory sector to fall even further, along with things like copper. Asia's manufacturing performance is seen as an important gauge for the health of global trade, and the latest set of PMI data points paints a varied picture. And here we can see, if we look at global copper prices now, we're going to show you what the impact the factory sector has. Here we have the general business activity for the Philadelphia Fed with their manufacturing sector. And sure enough, as you see, general activity for their manufacturing sector fall below that horizontal black line, showing a contraction in manufacturing activity. Look what eventually happened with copper prices during the global financial crisis. They came down. You can see it here in 2015, 2016, when the global economy was headed into a synchronized recession. Copper prices indeed came down, and we're seeing it now. So the notion that perhaps a mine going offline, or perhaps there's too many smelters, it doesn't really matter. What we're likely to see is demand for copper continue to fall, because not only is there not enough credit in the systems to support the prices, there's just no demand to support it from the manufacturing side. So it doesn't matter whether we bring on 1,000 new mines or we get rid of a bunch of mines. As you can see, the case of where copper prices and the global economy are headed are down. It follows a similar mixed signals out of China, underlying fragility within the world's second largest economy and adding pressure on the government to provide more stimulus measures to sustain momentum headed into the next year. So, it's amazing how we've gone to too much stimulus, too much liquidity, too much money in the economy to, wait a minute, perhaps we need to get some back because demand is going away. Consumers don't want to spend, and so we need to get governments involved. And now we're just seeing it in China. Of course, this isn't even where Goldman Sachs is warning us, but we've noted that China is a major problem here. Their economy is slowing down. They're a victim of being the world's largest exporter, that if global demand falls, there's nothing they can do. They can internally stimulate, but as we know, there just isn't enough demand there. There should be, but there isn't. The export-driven cakes and manufacturing PMI jumped to 50.7, beating estimates of a 49.6 score on Friday, suggesting that the export-oriented cakes and manufacturing sector has entered a very slight expansion. But keep in mind, the official manufacturing PMI fell to 49.4 on Thursday, marking the second straight month of contraction. So here we talk about kind of that soft landing where we saw that revival in the data, and as we suggested, it was going to start rolling over, because once we get through all those orders from the back to school and the holiday season, that there was going to be a vapor of demand. We're going to see all of a sudden a big gaping hole and it roll over, and we're starting to again see that happening right now. But there is a little bit of optimism as South Korea's exports pick up. But wait till you see what else is happening in South Korea as momentum, as chips bounce back. And one thing that should be driving a whole bunch of momentum is your trading account. I'm going to show you how one trade would have paid for all of your research for the whole year. Check this out. This is something we've been featuring on our Sunday show. We'll talk about the trade of GDX. This is that gold miner ETF that trades large gold miners. This is something a lot of people love to trade, and it gets them most of the time where they're on the wrong side of the trade. Let me show you just how you could have used our reports, and as a turn, with what you would have made, had all your research for free for the whole year, most likely. Here we see on November 17th, we had been noting to our subscribers, keep an eye on this because machine positioning had switched here and they were buying up off of a short level. We had been watching this. We had pointed this out on the Sunday show. And on the same day, we got that paired trade. This is what most of our successful traders do. They subscribe to both of our reports. Remember, the CTA is at machine positioning. Looks at what those machines are driving because they move a lot of money. And then we look at the technical signals. This was what Momentum Timer Pro does. We had one on the daily buy count where technical momentum turned positive. And now look, that took a buy it open on this red candlestick. Had you taken that trade, yes, you would have been down the next day, but that happens when you trade. As long as you would have held onto that, you'd be banking in right now, looking at, as of time of filming, a 9.86% return with more upside potential. You think about how that could have easily paid for both reports for the whole year. And right now, there are 5 coupon codes for a free month for each one of them. Grab them before they're gone. If you get to the checkout and there's no way to put the code in, it's because 5 people beat you to it. And one thing that is beating the experts here is exports out of South Korea. They rose 78.8% from a year earlier compared to experts calling for a 5% increase. But meanwhile, overall imports, we look at domestic demand from South Korea from the inside, dropped 11.6%, resulting in a trade surplus. Semiconductor shipments rose 12.9% in the first growth in 16 months, while automobile exports increased a whopping 21.5%. Of course, you kind of think about that UAW shutdown due to the strike. Of course, everybody wanted to export automobiles here to the U.S. to try to take advantage of that. Semiconductors makes perfect sense. They're catching up with all the demand for autos here in the U.S. The only question is, how long will that last? There's still reason for caution as economists see softening global economic activity next year, undermining demand for export products like countries from South Korea. The U.S. in particular may see consumption slow as benefits. And this is what we've been saying from fiscal investment programs dissipate. They should be gone. This is according to a forecast by Bank of America. This is an easy one. They should be gone. All that pandemic money should be largely wiped out now. At least we know that 30%, the bottom cohort of the U.S. income earners, they are struggling in a huge way. But we look at global demand, we look around the world, and we're getting to the point where we're going to show you what Goldman is calling for. This major country is going to collapse. Their economy is in bad shape. But let's look first, because we're talking about copper. And how can we talk about copper without talking about crude oil? And yet you get headlines like this where oil prices could reach $100 a barrel in 2024 if OPEC members fulfill pledges for voluntary cuts. Well, there you go. It's all about constricting supply. Maybe if they just turned off everything, they could get prices to go up, because the more they cut supply, notably what happens, price continues to fall, because it's all about the global economy. What we have said in the past is if you want the global economy to surge, you need cheap energy and lots of it. And what is OPEC doing? They're trying to constrict supply, drive prices higher, and it eats into discretionary spending, because you look at consumers around the world, they have rent, they have food, and they have energy. Well, you drive energy prices up, that leaves less money for, that is right, you got it, discretionary spending. Less discretionary spending means the factories don't produce as many goods. They're not producing goods, well, they're not transporting those goods. And if they're not getting to the stores, well, you still don't need all these people driving to the store or going to work at the store. All of a sudden, what do you see? Demand for energy falling, no matter what OPEC tries to do, as oil prices are expected to rise in the new year after some OPEC plus oil producers voluntarily pledged to cut output. Of course, OPEC plus doesn't understand the global economy, might as well call them central bankers. The oil cartel on Thursday released a statement they did not formally endorse production cuts because, well, they couldn't get everyone to agree with it, but individual countries announced voluntary reductions totaling 2.2 million barrels per day for the first quarter of 2024. Effectively, what they're going to do is drive the global economy into a recession by trying to tighten supply and keep prices elevated when they desperately need to fall to drive consumption. That is a key tenet here. But as we look at the relationship between the global price of copper and red against crude oil prices, this is West Texas Intermediate in blue. Notice a nice relationship suggesting if copper prices are headed down because, well, there's just not enough supply, well, that means West Texas Intermediate, because there's going to be less supply, prices are going down. I know we see this jokingly, but that's the whole point. Demand is going down. We can tell these two things are going to fall because, as I pointed out, it's all about the factory sector. It's all about demand. And here you can see we're going back to the Philly Fed manufacturing data. You can see that when it enters a contraction, you can get prices to rise. It's not an issue, but then they come crashing down. You see it again here, 2015, 2016, oil prices came down as demand fell. That's the key part. And while OPEC Plus wants to drive prices higher because, well, they've got bills to pay too, and inflation affects them as well, global demand says you can do what you want. Prices are likely to come down for oil across the board, again with copper. But now let's talk about Goldman's call here, because they're saying a major economy is teetering on the edge of collapse, and we're saying there's nothing anyone can do to stop it. And the problem is, when this country goes, well, there'll be a lot to follow. As Goldman says, ECB to cut interest rates sooner than expected. Of course, what we note here is that when economies turn around, because the issue here is everyone believed that inflation was an issue and the central bankers would finally get interest rates up and then they could hold them there or maybe trim a little if they needed to. But the idea is that we were in a new normal of interest rates. And we said that's not how the financial system works. It's not how the monetary system works. And now all of a sudden, we've seen the Eurozone economy start to slow down at a faster rate than is expected. The soft landing there is just a myth of the central bankers' dreams. And now all of a sudden, we're not talking about keeping rates up. We're talking about cutting rates, because when you cut rates, it's implying that the economy is crumbling beneath their feet. As the U.S. Investment Bank changes prediction in a report on Thursday, hours after data showed that inflation in the region weakened markedly toward the 2% goal targeted by policymakers. While we see a significant hurdle for rate cuts before Q2, the risks around our baseline are clearly skewed toward a faster cutting if inflation continues to slow more quickly than expected, or if growth fails to improve next year, or we'll just say it simply, if demand continues to fall apart because all these central bankers inverted the yield curves and money curves across every major industrial economy and constricted the creation of new credit. There is just no chance that the Eurozone gets out of this without the ECB massively cutting to zero and returning to QE. And of course, when they do that, you're going to watch a domino effect around the world. It makes us wonder whether we're moving fast to the old lowflation equilibrium, which we have been flagging as more likely scenario than inflation higher forever. This according to Bank of America. And it makes us wonder whether June 2024 could be too late for the ECB to start cutting rates. I'll make the case right now. It's already too late because they've done the damage and it's too late to fix it. Here you can see again the net percentage of domestic banks tightening standards for commercial industrial loans. When you invert money curves and yield curves, well, banks stop lending, they stop creating money. And historically, what you see as banks tighten standards, well, here you have the Federal Reserve starting to cut rates. They didn't waste much time during the global financial crisis as banks tightened standards. Well, they started to cut. You see going into the pandemic, they were cutting again, and now they're thinking they need to maybe even go a little bit tighter. But no, the reality is it's too late for the global economy. The central bankers have done their damage. There is this thing called a lag. Well, problem is we can't measure it, but we do know it shows up at some point. Meanwhile, Fed's bar wants banks using discount window for liquidity needs. Well, there's a reason why. As Michael Barr, the Fed's vice chair for supervision, touted the backstop as an important tool for financial stability and monetary policy. The ability to access funding at a predictable rate through the discount window should figure importantly into banks' liquidity risk management plans under a range of scenarios. One of the problems here is we know the banks are going to be back needing money. They're going to have no choice but to go to the Fed because not only have they tapped out their other lines for the most part, well, Congress it's not too happy about what's going on. Where banks turn from funding under stress became a topic of debate in the U.S. after several mid-sized lenders failed early this year. A recent government report called for the federal home loan banks, another source of funding, to direct lenders to the Fed in times of extreme stress. And you can see there's an article as the U.S. calls for federal home loan bank limits. After failing banks tapped lenders, this is a problem, and want them to go to the Fed. And there's a big stigma about going to the Fed. If you're taking money from the Fed, it says you're insolvent. Well, the problem is, we already know that small and mid-sized banks are insolvent. They can't cover it up for much longer because there's not much left for them to hold on to. Meanwhile, Powell brushes off rate cut speculation. Of course, he's not going to cut rates, not yet. He's going to be panic cutting in next year as Fed moves carefully. It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease. We're prepared to tighten further if it becomes appropriate to do so, but notably, he doesn't think that there's any reason to change here. He doesn't understand because he's looking at these lags. This is what he's focused on, and he's seeing no damage from the system. What we do know historically is when it happens fast, and that means the Fed will have a record drop to zero. As Powell signaled, the Fed officials expect to leave interest rates steady when they meet December 12th to 13th, causing the bond market to rally here and giving the Fed more time to evaluate the economy after raising rates aggressively from near 0% in March. Of course, the reality is we're seeing the economy slow. They're going to sit back and watch it until it comes crumbling down is what's really going to happen here. A slowing U.S. economy and fall in the inflation rate have raised expectations among investors if the central bank could begin to cut rates as soon as March, which we agree completely is likely to happen. Having come so far so quickly, the FOMC is moving forward carefully, Powell says, as the risks of under and over tightening are becoming more balanced. Well, I don't know what he means by that, the risk of under or over tightening. The reality is he can't even see that he over tightened. And with that, of course, we know that when the ECB is cutting rates because the Eurozone's crashing, well, that means the U.S., China, and every other major industrialized nation around the world will soon follow. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.